Hello and welcome to episode 6 of the New Trader's Playbook. Today we're going to be talking about building a strategy, or what's also known as an edge, and backtesting. So we have spent the last 5 weeks talking about candles and reversal structures and types of patterns, just the things that you need to understand when you're a new trader, how to see the market. But now we're going to talk about how to turn that into building your strategy and what that might look like for you. So let's take a look at what is an edge. What is a strategy? Well, essentially what you're seeing is your edge is just what gives you kind of an advantage in the market. It gives you that upper hand, right? It's something that has proven, importantly, statistical odds or probabilities that are based on a large sample size. And what that means is that you just can't have a proven edge that's based off of it having happened 5, 10, 15 times. You need a large sample size. You're going to need to see at least 100, 200, 500 examples of your strategy that you create working. That gives you proven, tested by you, statistical odds that it should continue working. Right? Also, having a strategy is essentially what stops trading from becoming gambling. It is very easy for trading to be gambling, right? You've probably heard that before. People probably said, oh, well, trading, all that is just gambling. It definitely can be if you go into the market with no strategy. If you go in there just saying, I'm going to just buy now because it feels right, or I'm going to sell now because it feels right, that is definitely gambling. And that we don't want to be doing in the market. We want to trade with proven, tested, statistical edges. Right? So that's extremely important. This is essentially how we stack our probabilities in our favor. Now, according to Investopedia, it says that a trading edge is a technique, an observation, an approach that creates a cash advantage over other market participants. Now, the only thing that I think is interesting, and I'll say a sidebar from what that said, is that we are not in competition with other people in the market. The great part is that when you go into the market and you trade, everybody can win. As long as we make sure we have a solid, tested statistical edge on our strategy, we're going to be able to make it repeatable. We're going to be able to make it testable, because if it's not repeatable, then we can't win. We can't succeed with it. And that is going to become the foundation of our success. Every single winning trader that you have ever seen or will see has some kind of proven edge. Okay, all of them. It's their repeatable way to kind of push the probabilities of the market to their direction, put it into their favor, purposely over time, so that the trades that they take, all of their wins, they outpace their losses. That's how we make money in the market, where your wins are larger than your losses. That's a key. But we have to find that edge, because that, as I mentioned before, is the foundation of your success. So let's talk about what a trading strategy would look like. The first thing is that it's going to have step-by-step rules. You're going to have to write these down. You're going to have to make the decision. Now, granted, we'll talk about this in a couple of minutes, what that looks like. And there are a lot of strategies. There's endless amounts of strategies, but creating one that feels right for you is extremely important, or using one that feels right for you that someone else has already created. So we have to have this plan in order. And the plan is usually going to contain things like your entries and your exits, patterns that you need to see in order to enter or exit. Maybe it will be based on types of indicators. You're going to see a lot of those on the internet. I am a big fan of non-lagging indicators, but a lot of people use a lagging indicator, and that is something that you'll see a little bit more in the future, indicators that change as price changes. Non-lagging means they're always the same, and those are a lot more beneficial, in my opinion. And also market structure. What is the market doing? Is it currently going up? Is it currently going down? What is the higher time frame? We talked about that a few weeks ago. Where's the trend? Where's the major trend on the higher time frames? So inside of our trading strategy, we're going to include setups. We're going to include risk management. And what that means is how you manage your risk. That's how much you plan on losing versus how much you want to win from each specific trade. And then trade management. Some people love to get into a trade and they have a location for their stop loss where they're going to lose the trade, and a location for their take profit where they're going to win the trade. And they never touch anything. It either hits the stop loss or it hits the take profit. Some people will wait for price to go part of the way, and then they will do what's called a BE, or a break even. Once you do that, then you don't lose any money if it comes back to you. But that's all something that you decide as a part of the creation of your trading strategy. The number one most important part, though, it has to be consistent. Consistency is key. You cannot have inconsistency with a trading strategy because the variables are too much. Imagine trading one way and doing that for a few days, and then trading a different way, changing a variable. Now you have two different sets of strategies, your information is inconsistent, so it cannot help you to create this tested statistical odds that we were talking about, repeatable, testable, but most importantly, consistent. Now, you know the name of this series is The New Trader's Playbook, but your trading strategy is your personal playbook, okay? And your playbook answers those questions like when do I get into the trade? When do I get out of the trade? What time should I get into the trade? Where's a good location on the charts to get in and out? When should I be moving my stop losses? Why should I be taking this trade? Is there a reason for price to continue or reverse from where we're at right now? And then with the risk management, as we talked about, how much is a good amount to risk? How much should I be trying to gain from each trade? All of that is included inside of your step-by-step rules that create your strategy or edge. Now, here is why every single trader needs to do that step of creation, but then backtesting. If you never heard the terminology backtesting, it just simply means that you are going to test backwards in time the strategy that you have created. If you go the other direction, it's called forward testing. So if every single day you go into the market and you try to test your strategy, that is forward testing. But that could be a problem if we're forward testing something that doesn't have statistical odds yet, right? So why do we like to backtest? And this is something that you should be doing on the regular if you want to start trading. The number one reason why we want to backtest is because it's the only true way to know if the edge you've created, if the strategy you've built is real, if it actually works, if it has legs, so to speak. Otherwise, you might just be dealing with something that is simply hindsight, or maybe, oh, I saw this happen a couple of times. Must be my success, my way to make money. Well, maybe not. Time is the only way that you'll be able to tell. Another really important reason why we backtest is because it saves money. Yes. One of the things we do not want to do is go into the market trying to, quote unquote, test out a new strategy with our hard-earned money. That is only going to cause you a lot of stress, and we don't want that. What we want to be able to do in our backtesting is be given the ability and time to catch flaws, right? Because you're going to go in there and you're going to start backtesting this thing, and then all of a sudden, this idea that you had that was so amazing, it's failing over and over and over again. And you're catching the reason why it's failing. You're saying, oh, I forgot. I should have done this, or I should have done that. 9 times out of 10, if I did this, it works out better. This is how we fine tune something that we eventually want to use to make money. It also builds your confidence and your discipline. Confidence in the market is extremely important, because if you don't have confidence, you're probably not going to push the button when you need to. You might be scared to push the button out of losses. So you don't push it at the right time, but then you chase and you push it at the wrong time. That is a part of discipline, right? We want to create inside of us this idea that we care about the process much more than we care about the progress. We don't want to be chasing the money. We want to be chasing consistency of our process with whatever this edge looks like. That essentially means you want to be a data-driven trader, which means you see data, you collect data, and then you use said data to help you feel confident, disciplined, and to be able to trade accurately. Backtesting is also one of the things that turns a gambling addict into a business professional, because it gives you real numbers. It doesn't just give you hope. It makes sure that you can actually build a career inside of the markets, as opposed to hoping that when you push the button and you're sitting there and you're praying and you're crossing your fingers. The market does not care about all of that. That's why we have to backtest. That's why we have to create data specific, driven, and odds in our favor, right? That is why we need to backtest. Finally, all successful traders will agree that backtesting is essential. And if you look deep enough, you're going to find that a lot of them say the longer you backtest, the longer you practice your trading without any money on the line, which would be simulation trading, the more confidence you're going to build, the more discipline you're going to build, and the less money you're going to lose, okay? So we see that as extremely important. So now let's take a look at some examples, and we are going to go ahead and let's just build ourselves a little strategy, okay? So let's build a strategy. Fantastic. Now, if you are building a strategy, there are a lot of things in this. Granted, you can find plenty of strategies that people are talking about on the internet. Many are available on YouTube. You wouldn't believe how many strategies are out there. I personally have created probably 100 different strategies in the past 3 years. But let's start off with something simple so you can understand the process of the strategy creation process. So one of the simplest things that I can think of is using the previous day's price range. Now, as I've talked about a few times on our website, we have on dreamindicatorsandtools.com, I've got a few different indicator packages that you may want to look at. And this is one of my favorite ones, which comes from the Key Levels Pro. And this is the prior day open, high, low, mid, close pro. Now, I have edited it a little bit to take out some specific things just so that we can see the previous day's high, which is red, the previous day's low, which is green, and the previous day's mid. Okay, these are extremely important levels, extremely important. So let's say that we're going to build this strategy. And let's say that the first thing we put into our step-by-step rules is that every time price breaks a prior day high, I will go short. And then of course, reverse that for longs. So if price breaks the prior day low, I'll go long. If the price breaks the prior day high, I'll go short. And remember, this is not a strategy I'm suggesting. This is simply us building what the strategy might look like from the ground up. Okay. So we have a catalyst for taking the trade, and that would be a crossing of the high or low from yesterday. Now, the next feature we're going to talk about is I will enter short and target the prior day mid. Okay, so I have to know where I'm going to enter, which would be, in this case, the prior day high, and I have to know where I want to aim for. What is my target? I've talked about this last week in episode 5. The prior day mid is like a magnet, so sure, why not? We know that information. Sounds like a great place to aim for. Okay, I will target the prior day's mid. If we hit the high, I will target the prior day's mid if we hit the low. Either way, we're heading to the same direction. Now, we have to go to risk management. Okay, what does that look like? Well, I will have a 1-to-1 ratio of risk to reward, which essentially means that my stop loss is equal to my take profit, right? How much I plan to lose is equal to how much I plan to gain. Now, I am not a fan of a 1-to-1 ratio. It is not what I do. I like much higher ratios. But as I said, we're building a basic strategy. So we're going to start off with something very simple that we can try and follow, right? Something that makes logical sense. Now that we have some very, very basic rules, next thing we want to do is we want to backtest. So let's backtest. What would that look like? Now, TradingView, which is what we're on right now, that's the platform that you've seen in these episodes. TradingView is fantastic. It's excellent for charting capabilities because not only can you get indicators, which look beautiful on here, very clear, very editable, but you can also do a lot with their features of creating boxes or creating lines or creating your levels and whatnot. It makes it very easy and a lot quicker to backtest in my experience. Also using an indicator like you're seeing right here, our prior day open, high, low, mid, close indicator can help to make this process a lot easier because I don't have to look at the previous day to find out what its high was, to find out what its low was. I can just turn the indicator on. Boom, done. So let's take a look now at how we might backtest. So we'll put this strategy thing over here and let's talk about how we might backtest. Now, of course, you'll want to backtest on a time frame that works for you. If you think you're going to trade on the 5-minute, backtest on the 5-minute. If you think that you need, for example, we talked about last week or a couple weeks ago, those reversal structures. If you're looking for something like a reversal structure, like we talked about a 2, a 1, a 2, 2, 2, 3 right here. If you're looking at reversal structures like that, then maybe you want to do that and test it on the time frame that you're testing. The good part about this is we can use a higher time frame because we're using a much bigger size for each day. Okay, so what we're going to do is use the forecasting tools for our longs and shorts. So let's take a look at what happened yesterday. Yesterday, price broke the high. So according to our rules, if price breaks the prior day high, I will go short. Okay, great. So we could come over here. We can do a short position right on this level right here, which would be our prior day high. Now, if you'll notice, this is the forecasting tool. Right there where it says number 1, that is a 1-to-1. That means that the stop loss and the take profit are the same size. So I'm going to inch these to the correct place. And you'll notice that yesterday we just barely got up here and we would have lost the trade based on our rules. Okay, let's write down some details because that's going to be really important. We want to keep track of what's happening. We want to remember it's got to be statistical. It's got to be odds, probability based, which means you also have to take down very specific information. So let's say we want to get granular on this and we want to find out how big was the stop loss and the take profit. That would be my first place to step. So the stop loss take profit, since they are the same size, was, as you see there, 320 points. Okay, great. Now the next thing that we can take note of is, was this a winner or a loser? Okay, so it was a loser. Cool. The last thing that we're going to want, just off the top of my head, would be how far this went in our favor. Did it go anything in our favor? Well, as soon as price came up here and it crossed over, we never got into the green area, which would be in our favor, okay? So in this case, price went directly to our stop loss and it went 0 points in our favor, okay? So now we've got this specific day set up. Boom, done, perfect. Now in this case, Wednesday, previous day, what happened? Price comes up, opens right here, struggles a little bit, and then you notice how it hits the high and then reverses. So if it hits the high, what are we gonna do? We're gonna take a short. We're gonna take it right there at the high. We wanna make sure that we've got these equaling 1. You see 1 to 1. And you'll notice that price went there and it went directly to our take profit. Okay, well, fantastic. That would have been a winning day. So we write that the first thing we need to know is how big are both of them. Our take profits and stop losses are both about 290 points. Now, why would I write this down? Well, me personally, I am very interested in data. So I want to know everything about this backtesting, because as you're backtesting, you can collect the most amount of data. If later on you think, oh, it would have been really nice to have this data, now you have to go back and do it all over again. So collecting as much data as possible ahead of time is extremely useful. So 290 points there, it was a winner, right? And then in cases of winners, we want to know, or I would definitely want to know, how far did it go against us, which is a term called drawdown. Drawdown means how far did a trade take you into the red. So all we have to do is look at from where we would have entered to how high it went. And you'll notice this is 28 points. Okay, cool. So 28 points goes into the red against us. Perfect. Then we just go and we take our next one, which as you can see here would be a short. So we'll take our short, or excuse me, it would be a long. So we'll take our long position right here, take it back up to the mid, make sure that the ratio is 1. And you'll notice that it was a loser. So now we have another loser, copy paste. Like I said, I love TradingView. We'll find out that this was 315 points on both sides, since our stop loss and take profit are the same, 315. And then since it was a loser, we also need to find out how far it went into our favor. So after it hit here and we would have been entered, it would have gone 126 points in our favor. Now, the reason why I would like these information is because, as I talked about earlier, some traders like to have a break-even spot. How far did price go in my favor before I decided I should bring my entry, my stop loss right here. So let's say price goes up to about the middle spot, and my rules in my rule book, in my playbook, is then all of a sudden I'm a 0 risk. Right? So at that point, if the trade comes back and knocks me out, I didn't lose any money, as opposed to what this would look like as losing quite a bit more. Okay. And then we'll do just one more. Let's look at this last one here. Price comes up, takes out the high. There's that. Come down here. We make our 1-to-1 ratio, and we notice that this one was in our favor. So we have another winner. Great, fantastic. All we're doing here is just what every other trader has done with backtesting, is taking in the data, collecting everything that we have so that later on we can take those numbers and compile them into something logical. And that logical information can later on help us to create a really solid strategy. Okay, so what have we done? We've looked at 1, 2, 3, 4 days. According to these 4 days, we've got 2 winners and 2 losers. Okay, perfect. Did we take any trades? Well, no, we're just backtesting, so we didn't lose any money, right? Exactly, we didn't lose any money. But over time, let's say we take this and we do this for the last 100 days. We do this for the last 200 days, right? That's important. What will that give us? That will give us the ability to create a collection of data. And let's see what that might look like. Let's say that I had the last 100 days, right? The last 100 trades, which would be represented by the last 100 days. It's not gonna be all of them, right? Because some trades are actually gonna stay inside. They're not gonna break the high or the low. And then of course that would be an example of a day we didn't trade, so then we'd keep moving. If we had 100 trades or 500 trades, whatever you decide to do, the more the better, honestly. And let's say that we collected data that said that 40 trades we got were winners. Now, the one thing that you're going to have to realize is how much is each side worth? Yes, we see the amount of points, but we can also just give them a specific dollar amount. So let's say that I risk, for my risk to reward, $100, okay? And if I risk $100, that means if I get a winner, I make 100. If I get a loser, I lose 100, okay? Hopefully that makes sense. So in this case, if I had a winner, then it would be 40 winners times 4 times 100 would be $4,000, okay? So we would have made $4,000. But unfortunately on the other side, that would have contained 60 losers, okay? And what 60 losers would have been a $6,000 loss. So you'd add those two up and you'd end up having approximately a negative $2,000 that you've made, plus fees. Right? Every trade has fees. So if you look at this and you've already done your 100 days, you can see that this is not a profitable strategy. Okay, it's not a profitable strategy. Now, there's a reason why, and I want to show you something real quick before we finish up. This is a fantastic chart that I found a while ago that I love because it explains to me, and I look at it all the time, it explains to me the importance of changing your risk to reward. We've been talking about a one-to-one, right? Which means that the size of your stop loss and the size of your take profit are the same. In order for you to be profitable, even a tiny bit, you have to be able to win 55% of all your trades. Right? So if you go in there and you do 100 and you don't have at least 55% of them, at least 55 of them are winners, you will not be able to have a profitable strategy. But one of the things that I really love is if you look to the risk to reward and you go to the right, you notice how you're able to get a lower win rate and still make quite a bit of money. If you have for example, let's just go to 1-to-2. If you have a 1-to-2 ratio, that means that your losers are half the size of your winners, or your winners are double the size of your losers. You only have to be successful 35% of the time, right, in order to make some kind of money. Anytime you see that in there, any money in there, that means that you've actually made something. Of course, fees might cause a little bit of issues, but that's something to worry about at a later date. Now, what would that look like if we were to do a 1-to-2? Well, instead of this being the same size and just having that 1 there, we would decrease the size 1-to-2. There we go. Okay, cool. It would be 1-to-2, which would mean that this is half the size of this. So as you can see, this is 328 points, this is 164. That's half the size. Now, we could backtest with that, right? What would it look like if all of these had have been half the size, right? Would I have lost out on my winners? Because that's a big deal. If you bring this size down, you might start losing some winners, but every single loser you have is half the size, okay? Which means, as we saw in this photo, that now I can actually see profitability somewhere around, let's look at this 20. I can see 20 ratioed profitability with a 40% win rate, as opposed to a 1-to-1 would require for 20, 60% win rate. So I can actually lose 20% more and make the same amount of money. I will tell you now, it's very difficult to get down into these levels of 80, 90%. But what is very easy is to increase the size of your reward to risk ratios. Okay. So with that in mind, we've made our strategy. We've built our strategy. Very simple. We've back tested our strategy over 100, 200, 500 different trades. The more the better. And then we've collected data based on what happened in those trades to see whether the strategy we think would have worked actually did. That is how we create back-tested, thoroughly data-driven strategies that we can then go into the market once we've found that they work, and then we can test them out forward testing, which would mean testing it each day, getting into the market, taking those trades, setting those trades up, and then continuing to take note of what is happening in the future. That is how we build a strategy and backtest. You will be building strategies in the future. You will be looking at other people's strategies. We might even talk about some strategies that I like to use in the future, as we kind of had in our last episode. Find something you love, find something that resonates, find something that works. Because as we've seen in these episodes, the market is not random. All we have to do is figure out how to capitalize on the moves that it's already going to make in order to make us some money. So thank you so much for listening today to this episode, and I will see you next week.